The bond market, structure, mechanics, and systemic impacts on economic policy. 1. Bond market overview and economic influence. The bond market exceeds $100 trillion globally and serves as the central mechanism through which governments, corporations, and financial institutions borrow capital. It underpins mortgage rates, corporate credit costs, equity valuations, and currency fluctuations. A bond is a debt instrument through which borrowers, governments or corporations, raise capital from investors in exchange for fixed or variable interest payments. Bonds are issued with a principal amount, a coupon, interest rate, and a maturity date. The United States Treasury issues bonds regularly to cover persistent budget deficits, making the U.S. bond market the foundation of global credit markets. Footnote: the bond market is the financial system's core infrastructure, influencing rates, inflation, and national debt funding. 2. Government borrowing and the budget deficit. The U.S. government consistently runs annual budget deficits, with expenditures surpassing revenues. For example, in 2024, the deficit reached $1.8 trillion. This shortfall is financed by issuing Treasury securities, bills, notes, and bonds. Treasury auctions occur on a routine schedule and are open to domestic and international investors. The U.S. debt-to-GDP ratio and interest costs are critical in evaluating the sustainability of this borrowing model. Short-term borrowing, particularly through Treasury bills, increases exposure to fluctuating interest rates. Footnote: Treasury securities fund U.S. deficits, but growing reliance on short-term debt increases fiscal vulnerability to rising interest rates. 3. Bond pricing and yield dynamics. A bond's yield represents its effective return and is inversely related to its price. While the coupon remains fixed, secondary market dynamics cause prices to fluctuate. If interest rates rise, older bonds with lower coupons decline in value, pushing yields higher. Conversely, if rates fall, existing bonds become more attractive, increasing their price and reducing yield. Auction results in the primary market serve as benchmarks for the pricing of existing bonds in the secondary market. Footnote: bond yields adjust based on market pricing, reflecting expectations for interest rates, inflation, and central bank policy. 4. Short-term borrowing and interest cost volatility. The U.S. increasingly relies on short-term Treasury bills to refinance maturing debt, a process known as rolling over debt. As older long-term bonds mature, the government refinances them at current interest rates. If rates rise, the interest burden increases sharply. This dynamic limits fiscal flexibility and risks crowding out other budgetary expenditures, such as defense or healthcare. Locking in lower rates through long-term borrowing becomes essential during periods of rising rates. Footnote: rolling over debt at higher rates increases federal interest costs, which may constrain future fiscal policy. 5. Risk-free rate and investment allocation. U.S. Treasury securities are considered risk-free assets because they carry virtually no default risk. The risk-free rate sets a benchmark for asset allocation decisions. When Treasury yields rise, the expected return from riskier assets, such as equities, must also increase to remain attractive. This differential is known as the equity risk premium. If this premium narrows, institutional and retail investors may shift capital from stocks to bonds, impacting equity market valuations. Footnote: rising Treasury yields narrow the equity risk premium, prompting capital rotation from equities to bonds. 6. Credit risk and high-yield spread indicators. Beyond Treasuries, corporations issue bonds with varying levels of credit risk. Investors demand a yield premium, known as the credit spread, for accepting this additional risk. In times of market stress, these spreads widen, especially in the high-yield, junk bond segment. The gap between government bond yields and corporate bond yields, particularly for low-rated debt, acts as a leading indicator of market fear and potential economic downturn. Footnote: widening credit spreads signal rising investor risk aversion and possible economic distress. 7. Inverted yield curve and economic forecasting. Under normal conditions, long-term bonds yield more than short-term bonds due to the time value of money. However, when short-term yields exceed long-term yields, the curve is inverted. This signals that investors expect lower rates in the future, typically due to recession or monetary easing expectations. An inverted yield curve is historically one of the most reliable predictors of economic downturns, reflecting a flight to safety in longer duration assets. Footnote: yield curve inversion often precedes economic recessions and reflects pessimistic long-term growth or inflation expectations. Let me know if you'd like a continuation covering the role of central banks, quantitative easing, or Fed Treasury coordination.